students are.
Okay, so we will start then. So it's September 26th, 2023. Um, this is module 5, and this module would be the beginning of a 3-part study of the 3 theoretical perspectives of global trade. And this study will build on some of the knowledge that we've already had covered in the previous weeks. And the 3 perspectives are liberal, realistic, and historical materialism. This week, we will begin with the first of the 3, which is liberal perspective. And this may sound abstract. And again, to reiterate, as I promised, I'm going to bring this class home to our daily lives and events that occur around us. So the liberal perspective, and the classic definition of the liberal perspective, is liberal economists emphasize the importance of free market and private property and seek to limit government's role in economic affairs. So economics emphasize the importance of free market, private property, and seek to limit the government's role in economic affairs. It has been said that liberalism is the most influential perspective in international political economy. And where it gets interesting is that, of course, liberalism believes in free market and private property and to limit government intervention. The point of contention between the 3 branches of liberalism, as we will now cover, is that there is not a consensus on the level on how much to limit government engagement in the economy. So, although some liberal economists favor as little government as possible, others believe that some government intervention is necessary for the effective functioning of markets. So just as there are 3 theoretical perspectives in global trade, liberalism, realistic, and historical materialism, there are also 3 perspectives in liberal, three variations of liberal perspective. The first is orthodox. The second is interventionist. And the third is institutional liberalism. Now, orthodox, it can be said to be the most pure form of liberalism. They believe in negative freedom. That is, that markets should be given complete freedom to function. On the contrary, the interventionist and institutional liberals believe that government and markets should not be given, the market should not be given complete freedom. So orthodox believe that the market will take care of itself, so that rational actors in the market will make rational decisions, and in so doing, that they will protect the market from running amok. The shortcoming with this thinking, obviously, is that the market is not as rational as we would like to believe. And very quickly, rationalism in this instance means utility maximization. That is, and this is one of those buzzwords, and in this case, a phrase that I say to you that every once in a while, we will introduce a few in each class, and you should write them down, and it signals that you have a technical knowledge of the subject. So utility maximization essentially says that people would make the decisions, people or institutions have rational sense of why they are engaging in the market, and they will make those decisions that will get them the most results that they desire. So you don't have to tell people, don't touch a burning flame, because they kind of don't want their skin to burn. The idea is that the first time you place your hand close to a burning flame, you realize it could burn you and damage your skin, then you won't do it anymore. So, and that is utility maximization, that the players in the market would make decisions that 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 returns the most value to them or the most utility. Here is another phrase that you should bear in mind. It's called laissez-faire. Laissez-faire essentially means leave alone. It's a doctrine opposing government intervention and interference in economic affairs beyond the minimum necessary to maintain peace and property rights. Rose, good evening. Thanks for joining us. So again, the shortcoming with the orthodox perspective is that actors do not always act in rational terms, and it fails to recognize the tension between short-term and long-term interest. And here's what I mean by that. When you're the CEO of a company, you have a fiduciary responsibility to act in the best interest of your company. The question is it what's in the best interest of your company in the short term or in the long term? And I'll explain that in a second. So every quarter, every publicly traded company would have put out an earnings statement. And that statement will be how your company has performed in the previous 3 months, and also signal how you would anticipate you will perform in the next 3 months and or beyond. Based on this call, the markets will react. And that market reaction could either push the value of your stock down or push it up. So there may be a long-term, there might be a play that may be in the long-term interest of your company, but in the short term, that it may dampen your stock. As one example, you could say, we are not going to pay as much dividend as we normally do because we want to retain some earnings because of the planned expansion in the future, or because of what we suspect is going to be market volatilities in the quarters ahead. There are going to be investors who are hoping for a huge dividend check. And when they don't get that, there might be levels of volatility that may put a downward pressure on your stock. And most CEOs would want to avoid this challenge. So again, the orthodox model fails to account that corporations don't always have the luxury of acting in a rational and utility maximizing model. The second type of a liberal perspective is interventionist liberal. The interventionist liberal believe in strong global institutions, as we have covered last week and the week prior. If you would recall, last week we covered the World Trade Organization. We covered the United Nations. We covered the World Bank Group, and we covered the IMF. These are all international institutions and organizations. And the interventionist liberal believe that these institutions are necessary to keep market fair and keep the trading systems competitive and open. The third is institutional liberalism. Institutional liberalism believes in the role of government in the functioning of markets, so that governments should be an arbiter, a referee, to cut down the excesses of the private sector and make sure that the activities are not very pernicious, or are not pernicious. They shouldn't be pernicious in the first place. So this would be the three distinctions. So in understanding these three distinctions, you can then see the source of conflict that informs some of the activities that you did the week prior, where there is tension between those who think that the IMF is useful, helpful, or that the IMF hurts more than it helps. And in understanding that tension, there is another phrase that you should know. It is called the Washington Consensus. Hello, Wendy. Glad you can join us. It is called the Washington Consensus. The Washington Consensus really is a set of macroeconomic policies. And these are the policies that IMF would encourage countries to engage in. These are the policies that causes the consternation that we debated. And here is the basic framework of those policies. The first is fiscal discipline. That is, government should maintain a reasonable balance sheet. Here's what it means by that. Many governments who are in trouble and go to the IMF have what they call budget deficit. So the government does not make enough money, generate enough revenue to support its budget. So you would have a government that has a budget of 5 billion, but the revenue is 3 billion. So it has to borrow 2 billion just to support its budget. That can be problematic because that 2 billion is not going into starting industries or building infrastructure that can facilitate trade. That is just to sustain your budget. The question is, how do you pay it back if it doesn't grow your economy? So generally, this is where the IMF comes in and says to a country, you have to balance your budget. That means you have to cut down the size of government and or reduce the programs that government sponsors, and you need to increase your tax collection rate. This is why IMF has that conditionality as an example. The second is public spending focused on economic return. And as I said, part of the challenge with budgeting is if you're just budgeting to meet your operations, that can be problematic. Or if you're just budgeting to equip your military, those can also be problematic because they don't lead to economic growth. And if you're going to need to borrow, you have to have a theory to grow your economy. So that can be part of the challenge. So public spending focused at economic return. Education, healthcare, and infrastructure, not defense spending or subsidies. So you want to invest in education, you want to invest in healthcare, you want to invest in infrastructure, that is roads, bridges, hospitals, etc., instead of spending it on defense or subsidies. The third is low tax rates. So if you want to attract especially international businesses, one of the ways to attract them would be a low tax rate. So if you want to attract what is called foreign direct investment, so foreign companies, foreign governments investing in your economy, you have to have a comparative advantage over any other country that they could very much invest in. One of competitive advantages might be cost of doing business, which tax is a big part of. The other is language skill, and the other is technical skills. So cost of doing business, of which taxes is a major significant contributor, is to be considered. The fourth is money supply, controlled by professionals, not politicians. That means your central bank has to be independent, and what we call in the United States Federal Reserve Bank. It has to be independent of political oversight and be run by professionals who make market-based decisions rather than decisions that are politically expedient. The fifth is exchange rates driven by markets. This can be a little bit challenging, and I'm going to present both sides. Part of on the positive side of it is that when market rates means the value of your currency. When it's determined by the market, investors generally, all things being equal, would have confidence in holding on to your currency. And that's why people hold on to the dollar, because the United States does not directly control the value of the dollar. It can make economic and monetary and fiscal, it can make monetary and fiscal decisions that can impact valuation, but it does not directly control the dollar. Problem with this, though, is that most economies that are really bad, if you leave your currency all the way to the market, and that's what they call float control, you might very quickly lose value and in consequence lose purchasing power. On the other hand, if you intervene too much, the market would lose confidence to hold on to your currency, because the market would not know how the president may feel the next day when he wakes up and what he's likely to do with the valuation of the currency. It undermines confidence in the long-term stability of your currency. The sixth, and there are two more, so bear with me. The sixth is open markets to trade and investment. Again, as we've covered in the previous classes, is not to erect barriers to trade and investment. That is crucial and critical. The seventh is deregulate economy and privatize national industries. Again, realize that these are degrees of and not absolutes. So absolute says you must deregulate 100%, and you must privatize 100%. These are variations of or degrees of, because it can pose challenges. One big example is the housing bubble that occurred in the United States decades ago, where the absence of regulation created challenges in the market that then caused a contagion, a global contagion, and affected economies far and wide. And very quickly, there was a realization that the market had to be, and we can go into detail about what actually happened with the financial crisis, housing crisis. But the point is, the broader point is, there was lack of sufficient regulation. But if you also overregulate the market, then the market will lose its dynamism. And then with that, will build some of the actors who might choose to go somewhere else and invest their money. The second part of that statement is privatization of national industries. The United States is a major player with respect to not necessarily having national industries. The closest we have to one is Amtrak. As a matter of being, the private sector controls and owns industry. There is different valuation gradations in Europe, where European countries own percentages in some industries that they consider commanding heights. For instance, the German government owns major stake in German railways, as one example. The Chinese have gone a totally different model. The Chinese believe in a state ownership model. There are pluses and minuses to each. And again, you have to look at where on that continuum between full privatization and state ownership, where in that continuum you want to exist. The most important thing, or at least the most critical thing, I think, for countries that are developing is to execute, is the execution model. The eighth, and I suspect to your, is protecting property rights. So it's very important that property rights are protected, and not just real estate property rights, which, by the way, dovetails into the event that the school is going to be hosting tomorrow with JLL Properties. And again, I encourage as much students as possible, especially those who are looking to build a career, to come network, hear the executives, build professional networks, and be able to hopefully leverage that perhaps into internships and or jobs. But as you will now know, the United States has successful real estate companies such as JLL, because protection of property rights is enshrined in our Constitution and in our laws and the way we conduct business. Property rights, obviously, as you also know from the WTO week, where the transition from GATT to WTO is the inclusion of services and intellectual property. So intellectual property has become as valuable today as manufacturing, if you will, because that's actually the underpinning for most manufacturing. So for those who joined us a little bit late, I'm going to recap very quickly. This week is the beginning of a 3-part study on the theoretical perspectives of global trade. There are 3 major theoretical perspectives to global trade. The first is liberal, second is realistic, and the third is historical materialism. We started this week with the liberal perspective. I also mentioned that the liberal perspective has 3 types. Orthodox, which is the most pure form of the liberal perspective. And in discussing that, I mentioned laissez-faire, which is a French word, and it means live alone, leave it alone. And then I mentioned the interventionist liberal, which is the belief in international institutions, such as we discussed last week. And the third is institutional liberalism, which is that governments should have a say and control the excesses of private industry within their jurisdiction. So this is the broad swath of this week's conversation. And of course, your assignments for the week. I'll be glad to take any questions. Okay. I don't have any question. You don't have any question? Okay. Wendy, Caddy, both of you are good?
Yes, Professor.
Yes, Professor, I'm good.
All right, so I'm going to take that to mean that I did a very good job. And, but you have my email. Within reason, if you need any clarifications, by all means, reach out, and I'll be glad to provide clarity. I wish you all very good luck on this week's assignment, and be well. All right?
Okay, Professor. Thank you so much.
All right. Take care, everyone.
Take care. Bye.
Bye.